Hey everybody.
Sean and Kelly here, Price and Price Group of Samson Properties. And what are we talking about today?
Today we are talking about how, the best indicator of future behavior is taking a look at the past behavior. We're going to tell you, buyers sitting on the fence and waiting for the market to crash and really buy that house. You're going to get what? The biggest bang for your buck?
Biggest bang for your buck? Yeah.
We're going to show you when that is based on history.
All right, here we go. Okay, so we're going to look at the history since the 1940s to see what the market has done and if it is a good strategy to try to time the market and if it is a good strategy to wait for that market crash to come.
Yeah, that's back when you were born.
That's wrong. So wrong. All right. So before we get into this, I want to look into it. I want to give some perspective with what these numbers actually mean. So
I'll be reading the numbers for you.
Yes, because I don't have my glasses on. So first thing to consider is when they're determining these values and the ups and downs, they're doing that based on median house price. So keep in mind, and we've talked about this numerous times on other market reports, median house price is when you take 10,000 houses that sold, is the house price of the 5,000th house. It's the one right in the middle.
Right.
So it doesn't necessarily mean that 5,000th house price went
average,
up or down.
Right?
It's not the average. It's just the house that fell in that market. So it kind of gives us an idea of what people are buying, but it doesn't tell us a value of a property. You have to actually look at the individual properties to see. But we're going to use that in this example just to show historically what's happened.
Yeah, and median is usually what's used across the board when talking about real estate numbers, right? It's the median. So that's why we're going to stick with that.
And the reason, my understanding is the reason they use that is because it's a large sampling, so they don't want high numbers or low numbers to skew it. They want what was right in the middle. So, so before we dive in, I want to look into three scenarios here real quick. The first one is we're going to look at $1 million house today. Okay, and we're going to talk about in the future. So we're going to take this $1 million house and we're going to look at what happens with a 5% appreciation over 3 years. What happens to the value of that house?
Right.
So the first year, 5% appreciation is
$1,050,000.
Yep. So
you just got $50,000 in only 1 year time from your $1 million purchase.
That's right. That's right. Then year two, what happens?
Another 5%, that gets us to $1,102,500.
Okay, so the key,
so 2 years, you've gotten over $100,000 on that $1 million purchase.
That's right. And the key, the reason that I'm bringing this up and showing this is because if you look at it, you say, hey, it went up 5% per year. You're thinking, okay, it went up $150,000, right? 5%, 50,000 plus 50,000 plus 50,000, 3 years, 150,000. But what actually happens is the first year it became a house worth $1,050,000.
Right.
So then it's 5% of
So they
that
go
value.
on top of each other, right? It's like this. It's not always based on that base number.
That's exactly it. So it's a stacking number. So by year three, we now have $55,000 in appreciation.
You have now increased your value, your money, how do I say?
Your equity.
Yes, by $156,625.
Yeah, beautiful. So what does that mean, actual number? So we're saying it's not going to be 15%, 5 times 5 times 5.
Right.
It actually comes out to
15.6%.
That's right. Okay.
And that's on $1 million house. It's not going to be 15.6% on every price, right? Because it's of that initial value.
Yeah. Your appreciation is going to be a little bit different. Right. So what happens in the same property if it depreciates 5% per year? Is it going to be depreciated 15%?
Yeah, you're like, well then, but it's so much smarter because then that's what I would lose. I would be losing $156,000.
That's right.
I'll be damned.
Yep. So let's see what happens there. So depreciation, 5% per year on a $1 million home. Year one,
you've lost $50,000.
Yep.
That sucks.
So year one, they match.
Yeah. But you had to live somewhere, right?
Yep. And now the home is only worth $950,000. So the next 5% comes off of $950,000, not off of the $1 million.
Right.
So now you lose, what is that? $47,500.
Yeah, you're at $9,025.
Yep. And then
you don't want to sell it then. I'll tell you that right now.
The only time you lose money is when you sell it.
Yeah, don't do that. Right now you're fine.
That's right. You're fine. And then year three, because you're again coming off that 902,500 or 500, you lose 45,000. Notice the depreciation number is going down each year, whereas the appreciation number was going up.
Right.
So in depreciation, in the same scenario, you've actually only gone down 14 point, what is that?
3.
3%.
It's not an 8.
That's right.
Take a guess.
So there's actually a difference there of 1.3% of appreciation versus depreciation, because the numbers, you have to know how the numbers work to actually see what these values equal. So as we're looking at this next chart, keep that in mind. Okay.
And then, I mean, really like 1 point something percent sounds like chump change, but think about that when you're looking at interest rates. And you know, we're all playing the whiny crybaby game whenever they go up by even 1/4%, right? Because it does make a difference. So over 1%, that's a big thing there.
That is, and
or a small thing.
True. Do know what you're looking at. And the thing is, let's say that you're waiting for 3 years for this market crash to happen. In that 3 years, you have now appreciated $156,000. So when you go to buy that house, let's say you do get that, and let's say you buy at the 3rd year of 5% depreciation. That 1.6%, you're still paying over $60,000 more for that house. But you think you did well because you waited for the numbers to come down, but it came down from a number that was super high. So that's where the catch is, and that's what people are dealing with in this market.
And think
right
about
now.
too, how long do you plan on being in a house?
Yeah,
you know, right? I mean, the average homeowner's in a house, what, between
5 and
now
7
it's like
years.
5 and 7 years.
Yeah.
I mean, I think it's starting to go to 4 a little bit.
Yeah.
In some areas, but consider that too.
Yeah, and the only time you lose money is if you sell when the prices are down. So it doesn't change your payment. It doesn't change anything if the values do go down. So this chart is a beautiful chart. This is started in 1942, and it shows what the market has done year over year. Now, this doesn't mean that, you know, in the middle of 56? It doesn't mean that in the middle of 1956, even though it was a 1% appreciation, it doesn't mean that maybe it didn't drop 5% at one point, but then it went back up. So it's an up and down, but the year finished out at 1% appreciation. So with this graph, over the last, 81 years, 73 years have had positive appreciation. 1 year has been neutral, where it was just flat, and only 7 years have lost money. Of those 7 years, 5 of them occurred during the 2008 crash. And they were significant. There was 1 year that was pretty significant.
Yeah, it was 12%. I mean, that was pretty serious. And that's when, you know, we saw a lot of changes with real estate laws and regulations with lending and all that kind of stuff. I mean, that was it forced a change that I think was very, very necessary.
But how many recessions and how many depressions do we have during this time frame? How many fluctuations in real estate and interest rates do we have? I mean, look at the 1980s. This is when it was in the 16% interest rates, and the prices did not come down. So the important thing to this is, if you are sitting back and you're waiting for this market to crash, number one, if it does, and it may correct a little bit, but it might be a 1% or a 4% correction. But how much are you losing as you wait over the years as those prices keep going up? Because our appreciation levels have been ridiculous the last several years. So if you've been waiting since 2020, and even if you got a 12% reduction next year, you just lost probably 38% on your money, because you waited through all of that appreciation that happened. So the point there is, the best time to get into real estate was 10 years ago. The next best time is today. All right.
The worst time was in 2006, and then you like sold it in 2008. That was like that was the worst.
That's the key. The only way you lose money is if you sold it when it was red.
We were that, right? We bought in 2005. We bought a house, top of the market. We had a terrible lending situation. I mean, it was shady to the point that they lost our loan file. And it all worked out beautifully.
But
I mean, it was weird and like would never happen again. But what I'm saying is, it's like, where's the real
risk?
The real risk.
Because you have the control, unless you have to move for a job or something, but hopefully there's a financial gain there. And even then, just rent the property. You know, you don't have to liquidate the property when the values are down.
Right now, we have so many people needing homes that, you know, they're having to rent and lease and wait for builders to finish building, that you're not going to have a problem. Like, this is going to be a good investment as investments go these days.
That's right. So our advice, it's a bad strategy to wait. It's a bad strategy to wait for that market correction to happen. And
Yeah.
and the thing that stimulated this video was I've talked to several buyers again that are waiting for the prices to come down. We always get we're waiting for interest rates to come down. That's easy to understand. As soon as they come down, prices are going to skyrocket because it's going to flood. But the ones that are waiting for the market, for the prices to come down, it's a mistake. It is just a mistake.
Yeah.
Okay. All right.
Right.
You have anything else?
You marry the price and you date the rate.
That's right.
I always want to, I mean, seriously.
That's true. That's true. Okay. So now if you have any questions, please feel free to reach out to us. We'd be happy to answer them. And